While analyzing any stock, it is very important to check the debt levels of the company. Generally, it is preferable to invest in a company with zero debt. Zero debt means a company does not need to borrow money from external sources and it is able to run its business with the money generated from its day-to-day operations. But does it mean that if a company has taken debt, then it is bad? No, there is no rule that debt is bad. In fact, debt can be good as well. But if debt can be good, then how much debt is good? And how much debt is bad? Hello everyone, my name is Sahil and this is my Personal Finance Academy where I explain everything about money management in layman's language. Many people confuse debt as bad, but that is not 100% true. In this video, I'll explain the good, bad and ugly side of debt with real world examples. So let's get started. First of all, let's understand what is a debt. For any company to start the business, it needs money. Now it has two options to raise money. First option is via equity and second option is via debt. For example, let's say a company is worth rupees 10 lakh at the beginning. Now if you need to raise money via equity, then you need to give a certain portion of company share to the person investing in the company. For example, if the person invests rupees 2 lakh, he would get 20% ownership in the company. So if tomorrow the company value become rupees 40 lakh, then the person would get rupees 8 lakh. And if the company fails, then the person can even lose all the money. So it is a high risk, high reward game. Alternatively, the founder of the company can raise money via debt. It is also known as loan. For example, the founder can approach the bank or an investor for let's say 2 lakh rupee at 10% interest. In this case, the founder is not giving the ownership of the company, but agreeing to pay a fixed interest on the money every year, irrespective of the profit or loss it makes. I hope this is clear. Now the same concept is applicable even for a public listed company where they either need money to run their day-to-day business or expand the business. Normally, a debt-free company would use the profit it generates from its business to run its day-to-day business as well as for the expansion of the business. But sometimes companies need additional money for expansion of their business. This is over and above the profits they generate. The company can either raise money via dilution of equity where the promoters sell the share to retail or institutional investors, or they can raise money in form of debt by issuing bonds at a fixed interest rate. Now let's first understand when can a debt be good. Let me take an example to help you understand this. You want to start a business and have rupees 5 lakh to invest. After a year, business gave a profit of let's say 12%. So your return on investment would be 12% of 5 lakh, that is rupees 60,000. However, you need to pay tax of 25% on profit. Hence, the tax would be 25% of 60,000, that is rupees 15,000. So your final profit would be rupees 45,000, that is 9%. Now let's take a flashback. You want to start a business and have rupees 5 lakh to invest. But in addition to this, you take a loan of additional 5 lakh at 8% interest. This makes your total investment as rupees 10 lakh. After a year, your business gave a profit of let's say 12%. So your return on investment would be 12% of 10 lakh, that is 1.2 lakh. Now you pay back the interest to the bank. So the total interest would be 8% of 5 lakh, that is rupees 40,000. After interest, you are left with a profit of rupees 80,000. 25% tax on 80,000 would be rupees 20,000. So your final profit after tax would be rupees 60,000 or 12% profit. Now can you see the difference in both the cases? In case 1, without debt, you got a return of 9% on the investment. However, in case 2, with additional debt, you got a return of 12% on your investment with an additional profit of rupees 15,000. So as long as you are able to generate higher return from your business as compared to your cost of borrowing or the interest rate, there is no problem with the debt. But this should be done in a limit. Otherwise, if you take too much debt, then you need to pay a lot of interest. And when you pay a lot of interest, it would eat away your profits. Normally, as a thumb rule, it is advisable to have debt less than your total equity. Or in other words, your debt to equity ratio should be less than 1. Let's take the real world example to understand the good, bad and ugly side of debt. So Reliance Industry has taken a debt of rupees 2.5 lakh crore. Reliance Industry debt to equity ratio is 0.42. Now Reliance used this debt of 2.5 lakh crore to set up the geo infrastructure all over the country. This has just started giving rewards to the company and it would continue to generate profits for Reliance in the long term. This eventually increased the share price of Reliance from rupees 500 in 2015 to currently at rupees 2000. Please note that we are considering the split adjusted price. So in this case, the debt has been good. Tata Motor has a current debt of rupees 1.15 lakh crore. In fact, on March 20, the debt level was as high as 1.25 lakh crore. So Tata Motor debt to equity ratio is 2.28. In this case, Tata Motor took a lot of debt, due to which they had to pay a lot of interest on this. Eventually, it impacted their profit. In fact, they were in loss since 2018 consistently until recently where they started showing profit. As a result, their share price fell down from the highs of rupees 550 in September 16 to the lows of rupees 70 in March 20. The share price recovered to the current level of rupees 294. But it is still much below the highs of September 16. Please note that debt to equity ratio is not applicable for banks and NBFCs because their entire business model is based on taking money from depositor and giving loan to customer. In case of Jain Irrigation system, their debt is rupees 6,300 crore and debt to equity ratio is 2. Due to high debt, they had to pay a lot of interest. On top of that, their business performance declined and they reached a state where their operating profit were lower than the interest charges. Eventually, this resulted in the fall in share price from rupees 143 in January 2018 to rupees 3 in April 2020. There are many examples where a high amount of debt has been bad. For example, Anil Ambani Group went bankrupt due to high debt. Kingfisher Group went bankrupt due to high debt and many more cases. So if we conclude, debt is not always bad. In fact, a certain amount of debt is acceptable as long as the company is judiciously using that money from debt into its business. Normally, a debt to equity of less than 1 is preferred. Personally, I avoid companies with too much debt. For example, many people are talking about Adani Greens. But if you look at their debt structure, they have a total debt of rupees 19,747 crore, which is 9 times its equity. That makes the debt to equity ratio of 9, which is very high. Now I am not commenting on the business. I understand that Adani Green is working on renewable energy, which is the future. But I am not comfortable with such huge debt levels. In the past, Suzlon Energy was one of the leaders in the energy business. But we all know how Suzlon became one of the biggest wealth destructor in the country. And it was mainly due to high debts. My point is simple. When you have so many great businesses which are debt free or have very low debt, why to take such risk with high debt companies? Some of the debt free or negligible debt business include TCS, Infosys, HUL, ITC, Asian Paints, Titan, Pidilite, Divis Lab, Eicher Motor, HDFC AMC, IRCTC, Tata Elxsi, Polycab and many more. I hope now you understand the difference between the good, bad and ugly side of debt. What are your thoughts about debt? Do you consider debts before investing in a company? Do let me know your thoughts in the comment box. And if you want to learn more about the important parameters to consider before investing in a stock, like what is ROE, what is ROCE, etc., and how to analyze a stock in detail, then you can explore my course on money management. It also includes everything about mutual fund, insurance, tax planning, etc. Link is in the description box. And friends, I just want to remind you again that I never share my WhatsApp number in the comments. If you find my name and photo with WhatsApp number, then it is fake. In fact, now it is very easy to identify the fake comment. I have received the verified tag from YouTube. So the fake comment will not have that verified tag. Plus, my name is always highlighted. If you find this video useful, do share it with your friends. I will see you with another informative video. Till then, take care.